Thank you very much indeed, Paul. I tell you, that was extremely useful and very simple so that everybody can understand exactly what the rules are and so on. We've got a huge amount of questions, which we are now going to have in a minute. But before I do that, I would like to introduce the panel today. There are two people who are going to be joining Paul on the panel. The first is Amit Shah, and the second is Devesh Ambasna. Amit Shah is a partner in the specialist pensions and actuarial consultancy Nigel Sloan & Co., who have offices in London and Monaco. He's a qualified actuary who trained with Mercer UK and then joined Nigel Sloan & Co. He has over 25 years experience as a pensions actuary, advising both corporations and individuals on structuring and funding pension arrangements, both in the UK and abroad. His clients include small to medium-sized corporations, professionals, as well as individuals from all walks of life. He has particular expertise in advising directors of owner-owned management owner-managed companies in structuring their own pension arrangements and how funds may be used efficiently to further their own business activities whilst protecting their retirement. He's also experienced in evaluation of various pension rights, including pension sharing on divorce. He's a director of Nigel Sloan & Co.'s trustee company that provides independent trustee services to self-administered pension schemes, including SASSs and SIPs. So a second panelist is Devesh Ambasna, who is the founder and principal partner of AWS Advice. Devesh started his financial services career as a graduate recruit with Hambro Life in 1981. With support from clients, he went on to develop his own practice and has never looked back. Throughout his career, he has garnered significant experience of helping clients with building, preserving, protecting, and distributing wealth. Devesh holds the Chartered Insurance Institute's diploma in financial planning, and his specialist areas are retirement, investment, inheritance tax planning. He has been awarded the Statement of Professional Standing by the Chartered Insurance Institute and is one of the few practitioners to gain the internationally recognized ISO 22222 standard in financial planning. So welcome all of you. And let me start off by giving you a quick question. If I may pass this one on to Devesh, please. Devesh, this is somebody who retired early, but have some years to go to before the actual retirement age, 6, 7 years or whatever it is. How should they be planning their pensions and drawdown generally?
Well, generally, if they've accumulated pensions, it depends whether they've accumulated them in money purchase pensions, which means there's actually a pot of money. Yep. It might be in several pots. It might be also with previous employers. There might be final salary schemes. So when somebody's sort of maybe 5 to 7 years from retirement, that's a very good time to start to plan to get the facts, understand where the money is, what pensions they've got and where, what risks they're taking with them, what charges they're paying, and then consider all the options. And options are going to be very personal to those individuals, you know, their family circumstances, their inheritance tax situation, their own personal cash flow needs, their personal tax situation now and in retirement. Now all of those factors are going to come in as to what they do right now.
Okay. Do you guys want to add anything to that, Paul and Amit?
I mean, I would just say, I mean, with retirement planning, it is down to personal taste. It's, again, the things that I've said at the end, which I've not discussed, it's down to risk, timelines, it's down to how much are in the pots as to how best to go into drawdown or how to do a combination of both drawdown and taking tax-free cash. So it is important that, you know, I can't emphasize enough that people just shouldn't just jump into retirement and not without taking advice.
So one thing I would say about retiring early is taking benefits before maturity. So if there are personal pension plans, for example, um, there may be penalties in drawing monies early, and there could be some guarantees which only are available at their normal retirement dates, which were set. So we just need to take care before drawing early.
Okay, Sandeep, you've got a question.
Okay, Paul, a question for you. For a defined benefit scheme, if the stated retirement age is 65, but if one decides to retire early, say at the age of 55, what are the consequences?
Right, that's exactly what Amit just referred to just now. There is a likelihood, if you're in a defined benefit scheme, there will be penalties for taking the pension early, because remember that the scheme is going to be paying you that much longer, and therefore there could be staggered penalties for going early. So before you make that decision, you need to do the investigation and find out what the penalties possibly would look like to take that pension early, and obviously then make a decision whether it's the right thing to do. But yeah, absolutely, Amit's already covered that point, but absolutely there more likely will be penalties to go out early.
Defined benefit schemes are slightly more complicated. It really depends on the rules of the scheme, whether they do allow early retirement without the classic actuarial adjustment. Some do, some don't. It's just each case needs to be looked at. But in any event, the longer you leave it, the higher the pension in both money purchase or defined benefits. And it depends on your needs, your tax situation. You might be a higher rate taxpayer now, could be a lower rate, so it's better to defer it until you become a lower rate taxpayer.
Okay. The question for, I'll pass it to Paul, this one. I have 5 work pensions, and I think it's a question quite a lot of people have asked, sort of scenario. What should I do? Should I consolidate these? Assuming there was a question about a defined benefit scheme and a final salary thing, but this is like either you have 5 money purchase or 5 final salary schemes. I'm not so sure. You might want to talk about both aspects.
I mean, again, you can't, I can't say whether you should consolidate or not. Each pension scheme or each pension we would always say that you'd need to find out more information before you make the decision to consolidate. I mean, a typical advisor would write out to each of the providers and ask a fairly large list of questions to get the information they need, and then basically then sit down with a client and then decide, right, okay, what do we do? Do we consolidate? Because as I said, some schemes may have generous annuity rates. Some schemes may be, as I said, if they are defined benefit schemes, again, these might not be able to be transferred out or shouldn't be transferred out. Again, on the defined benefit side, you have individuals that specialise in that area in particular. So it's not an easy answer. It is about, let's investigate first, get the information, get the data, and then sit down with you and decide whether or not it's in your best interest to either consolidate all, part, or none at all.
So so what the real answer is that I think whoever's got these type of arrangements, if they have 3, 4, 5, it's a worthwhile exercise to actually go and sit down with somebody, a professional advisor, and try and get the advice on this, rather than just trying to do something without thinking about exactly what you need.
Yeah, I just use a simple analogy. When we go and purchase a car, we'll spend hours, days, weeks investigating, researching a car, and then we'll buy the car, and the minute we take it out of the showroom, it depreciates in value. And yet people spend less time looking at their pension. So, and yet this is supposed to be an appreciating asset. So, you need to take time when it comes to your pension.
Okay, thank you. Sandeep?
A question for Devesh. And actually, just before that, a lot of people are writing in about multiple pension plans with different employers. So I think you've answered a lot of the question in terms of amalgamating, etc. So come on to that. But question for Devesh, if you have a workplace pension, is it also worth putting into a second private pension?
Yeah, generally, yes. I mean, so the workplace pension will have typically a certain limit. Yeah. So what it means is that a workplace pension will have a certain percentage from the employer and a certain percentage from the employee. So the first thing we would say is the employer's money is effectively a free contribution. So we would advise everybody to make sure that they pay what's necessary in order to maximize the employer's contribution. Right. Now, once you've done that, you've got a couple of choices. You can pay more into that workplace pension. And that workplace pension, again, just depends. It may have the choices. It may have a choice of investment options. Usually the charges would be lower on a workplace pension. You know, some of them you can invest and monitor as easily as a personal pension or a SIP. So it just depends on your workplace pension. But if your workplace pension is like, for example, a Nest government-sponsored one or a fairly basic scheme, and you want to have a wider investment choice, you want more control over where your money is being invested, etc. Then, yeah, then once you've maximized what you can in your workplace pension, then you can top it up on a secondary one, and particularly if you're a higher rate taxpayer. You know, if you're a higher taxpayer, you know, paying 40% tax or 45, or even in the tax trap, paying 60% between 100 and 125,000, then definitely worthwhile looking at pensions, both as part of your tax planning and as part of having a wider choice of options.
Excellent. Okay, over to you, Rumit.
Yeah. Question for Paul, please. Paul, this is relating to the NIC stuff, where people make sure that they're paying. How do people make sure that their state pension contributions still continue if they've retired early, for example? It's a three-pronged question. And there was a similar question where somebody had a 3 years gap in NI, and can that be made up? Go on.
You can make up for lost contributions, but you need to contact HMRC, and they will be. And I hope someone will back me up on this.
I think, yeah, if you look at the what Paul described in his presentation, the government website, you can see what history of contributions. Usually there is that option there for any particular years which haven't fallen out. You can actually make up by paying a small premium. Actually, it's a very good value. So if you get that option and you think you're not going to get the maximum number of years to get full state pension, it's worth paying that premium. It's really in low, it's sort of tens or low hundreds.
Yeah. And is there a time limit on doing this?
It's quite a long time limit. I think it's up to 10 years, actually, if I'm not mistaken.
All right. That's
just to add to that, I know there are a couple of questions about the national insurance, and if somebody's working abroad, for example, and if you're overseas, or if you have a period where you retire early, you can either pay voluntary national insurance, and that's very good value for money. But the aim being that you want to make up your number of years, your 35 years by the time you get to state retirement age. So once you get your state pension forecast, the one that Paul showed you the link, once you get that, if you see that there's a shortfall in the number of years, you can then pay voluntary national insurance in order to make it up. If you're close to it, close to retirement, you can generally go back. You get a quote from Social Security. They'll give you a quote. Typically, you can make up to 6 years back. But that costs slightly more than the voluntary national insurance. So if you've got time, if you get the forecast and there's a shortfall, definitely worthwhile looking at paying that additional voluntary NI to make it up. And
does this work if somebody has gone abroad for a while, so there's a gap effectively in there? Exactly. Yeah, and then they come back. Yeah. Exactly that.
Right. So whilst they're abroad, if they pay voluntary national insurance, that's going to be a lot cheaper than coming back and trying to make it up.
Yes. Yeah, that's great. Thank you. Sandeep?
Thank you. I mean, I think I direct this one to you, but it could be a multiple, all of you who may need to answer this. How is retire-ready pension from Aegon different to a workplace pension? Is it best to merge workplace pension into these?
I would say that, given that you've been product specific here, no disrespect, we need to investigate it in detail before we give any decisions, because, as Devish said, workplace pensions typically have low running costs. Yeah. So if you're just doing a cost comparison, it might say, well, no, don't do it. But we don't know. That needs to be investigated on an individual basis, because you have, as I said, I've not talked about providers, and because you've mentioned a provider, you need to basically book an appointment to see someone to get that looked for you.
Yeah.
I mean, you would have answered it exactly the same way, I'm assuming.
I think, yeah, because I'm not really familiar with the Aegon contract, and secondly, I don't think it's right to comment on any particular provider without.
Fine. Ramit?
Okay. Yeah. I'll go to Devesh. Devesh, somebody has a SERPs. Can they mix that with their private pension funds?
No. So there was a time when you could have contracted out of SERPs. So SERPs stands for State's Earnings Related Pension Scheme. So it was a top-up to the basic state pension. So basic state pension has gone through a lot of reform. But from sort of 1988 all the way to like 2001, if you were with an employer that basically didn't provide you with an occupational scheme, you were automatically contracted in to SERPs. Yeah, so SERP stands for an additional pension that tops up your state pension. Now at that time, you could have opted out of SERPs and had that additional net insurance payment that was going to top up the state pension, and had that paid into your personal pension. So there was an option to basically opt out and have that additional net insurance go directly into your personal pension, so you had full control over it. But if you have any SERPs benefit now, no, you can't opt out of that now and add it to your personal pension.
Devish, I just checked. Basically, everybody was contracted back in on the 6th of April 2016.
Yeah.
So any SERPs pensions that people have got before that date, they still are. The good thing is they have because of pension freedom, SERPs pensions, personal pensions all fall under the same umbrella now in terms of how you access your cash. Yeah. But everybody got contracted back in 2016, and there's my example, because mine was contracted out through a large employer I work for, and as such, I've still got that additional pension. But typically, if they're in a money purchase scheme, it's the same as a personal pension, but no one can contract out. Yeah, so that I just want to add to that. That was all.
It's quite strange, because when they allowed contracting out after a few years, it was very bad value for money. But now what they've done is they've consolidated the SERPs and the basic state pension into one. And those who actually did contract out have actually got a separate pot of money sitting there.
Yeah, that's right.
And can I ask what happens to the pot of money which is in the government scheme, obviously the SERPs or the NI, the minimum contribution pension that we get? What happens to that pot on the death?
It's same as any other pension now. There's no concept of protected rights anymore. So that pot used to be called a protected rights pot, which was quite restrictive. But now it's same as any other pension, so you can do whatever you want.
So you would have to make a wish or a specific wishes to get it out to the IHT?
Actually, on that point, there are two types of, without boring you too much, there are two types of schemes. One is contract-based, and then the other one is trust-based. Most pensions are trust-based these days. So if you do a letter of wish, that's fine. Then the trustees have got discretion, and it's outside your estate, so no inheritance tax. If it's a contract-based pension, which a lot of personal pensions used to be, you actually need to write those death benefits in trust. So most insurance companies or pension providers will provide a simple trust document. So you need to make sure that those contract-based plans the death benefits are written in trust. Otherwise, there's a danger that they could become part of your estate.
That's very useful to know. I think that's very
Very.
useful. Sorry, Sandeep, carry on.
All right, Paul, question. This is actually directed at you from someone. So I'll just read it out to you. Paul, you mentioned that for higher rate taxpayers that HMRC add £40 for every £60 contributed to their fund. Is that correct? Or do HMRC add 25% as with basic rate taxpayer and the remaining is repaid within your tax return?
Okay. First, it's not 25%, it's 20% now.
Yeah.
So max 20%. Now, again, it depends if you're employed and it's done through your pay, your 40%, your additional 20% could come back through your salary. But in some instances, if you're doing a private arrangement, you have to personally go and get that additional 20% relief back. And I hope the guys with me will back me up on what I've just said. But bottom line is it's not 40%. Everyone will get their 20% unless it's done through salary, and that's a bit more complicated to look at. But you would always need to try and claim that additional 20% back from HMRC. And if you don't, again, guys, I don't know how far you can go back because I can't recall how far can you go back and get that relief back.
Actually, 6 years, I think.
6 years. Yeah.
Check, because if you haven't claimed it back, you've been paying into a pension scheme, and if you've not been going back or giving it to an accountant to claim that money back for you, you need to start looking at getting that money back because you're actually owed that money. Now the thing is, you claim back your 20%, it's not paid into your pension; it's actually paid to you. You can then decide to put it back into your pension. So effectively, you're recycling back into your pension, but that money will be paid out to you when you claim it back from or adjusted on your tax codes.
Yeah, I mean, I think in practice, most higher rate taxpayers would be submitting tax returns. So it would probably come out in the wash when you do your tax return. So you will get the higher rate relief through the self-assessment.
Although there's tens of millions of pounds not being claimed.
Yes.
Either people forget, they've got a direct debit going out, they forget to tell their accountant, they forget to enter it into their self-assessment. They've got an old policy, that's been running, something like that. You find so many people who don't claim that additional relief, and HMRC owes tens of millions of pounds on that. So if you find that you're paying into a policy or a premium, so somewhere where you haven't claimed, it can also be in a company-sponsored personal pension as well. So if it's an occupational pension, like that's one thing. You get tax relief at source, but a company might have a group personal pension. So the company employee puts money in, they deduct it from your salary to put your contribution in. But if you're a higher rate taxpayer, then you need to claim that higher rate relief yourself. And so many people miss out on it. So if you find that you have, then typically HMRC will allow you to go back 6 years and claim it.
And this is where professional financial advice is extremely important, because are you giving away tax benefits that you could have quite easily got back?
Okay. Ramit?
Yeah, okay. Just somebody, I think if they were employed as a result of that direct employment, were part of a pension scheme, and when they leave, they could potentially be working for, let's say, not going self-employed, might work for different agencies as just working on a different contract. And each of the agencies will be offering you a pension scheme to contribute to. Is it better in the sense of these guys actually contributing to each of those pension schemes, or is it better for them to set up a separate plan like a SIP or whatever, and so therefore everything is consolidated technically in one place rather than having too many different pension schemes? And just in terms of I'll just follow up with another question somebody had asked. What are then the advantages of having a SIP generally? So if I can ask Amit on that one, please.
Yeah, okay. Now, first of all, if an agency or employer are offering a pension arrangement, that needs to be looked at, because usually they pay all the costs, charges to do with that arrangement. And therefore the charges are low. then the next thing to look at for that arrangement is what types of investment choices they're giving, what types of returns those funds are performing. And usually it's a good idea to remain in those sort of schemes which the employer is offering until you actually stop contributing. But if you find that these are not suited to you, then it's probably worth setting, and if you're not going to lose out on the contributions, then it's worth setting up something of your own. SIPs come in all shapes and sizes, but it depends on how much flexibility you need from your pension and how verse you are to handling that flexibility. So generally stay with the employer scheme if it's a good deal. It's a good idea to consolidate everything towards retirement, subject to everything that was mentioned before about penalties and guarantees and so on.
Okay, thank you.
Okay.
Any?
All right. So, question for Devesh: transferring a property from a personal to a SIP or another form of SSSA cannot be done in specie anymore. That means there needs to be a sale and an arm's length transaction, thereby capital gains tax and stamp duty would apply. It says needs careful evaluation. Do you want to just comment on that?
Yeah, if I understand what the question means, is that many individuals will be from time to time considering whether they should put their property, if they've got a commercial property, should that commercial property, is there a benefit of it being transferred into a pension structure? Yeah. So basically, the pension is nothing more than a structure, which, as Paul has mentioned already, and it gives you lots of tax benefits. So if you have a property which was within the pension structure, and your rental income paid is free of tax, capital gains tax. When you come to sell the property, will be free of capital gains tax. The value accumulated will be free from inheritance tax. So the pension structure is about the most tax efficient structure you can get. It's like having a tax haven onshore for all of us. Tax free in every way. Now, if the question is saying, therefore, should a property be transferred into the pension to benefit from it? Well, the first thing is that then you've got to look at the fact that that will be a sale and purchase. If you imagine, even if it's in specie, which means you're transferring the asset, for all intents and purposes, it's a sale and purchase for capital gains tax purposes.
Yeah.
So if you've had the property for some time, you're immediately going to potentially have a capital gains tax liability, and there are lots of other things to consider, which is probably beyond the scope of this webinar.
Yeah.
But basically, nobody should take any steps with this type of thing simply on one view, one-dimensional view to say, right, I'm going to save tax future on rental income and capital gains tax, so therefore you should go into a pension. As I say, it depends on lots and lots of other circumstances as to whether it's the right thing for you to do or not. But if that's what the question is asking, then the simple answer is yes. There would be an immediate tax liability, and it depends on how long you've had the property and what that tax liability is, and your own personal and family circumstances as to whether it's worth doing or not.
Yeah. So think it through very carefully before you make the final decision. Okay.
Yeah, especially sorry, on that point, especially for business property, then sometimes it's better to keep that in the business, subject to, of course, other considerations, as it would be part of the business, be immune from all sorts of things. But if it's a normal investment commercial property, then certainly the pension wrapper is probably the best thing.
Okay, just following on from that, there was just a quick question, not a question, just a point. I mean, from an inheritance tax perspective, obviously a pension is a very efficient way of leaving your estate technically down to the next generation. So in reality, when considering some of these things, if you have other wealth, etc., which can last you the lifetime, and you can survive on that cash, then the better way is to try and put as much money as you can into a pension scheme which will then obviously you can transfer it down the chain to the children as tax-free or inheritance tax-free anyway.
Yeah.
Yeah. Okay.
Yeah. I mean, that's what we've got to be careful about there as well is pensions being, as I said, probably the most tax-efficient structure that we have. The government, as you would expect, have fiddled with the rules over the period of time, which has meant that people don't do what you just said, which is let's shove everything into a pension, use all our other assets that we need for our expenditure, which means the pension grows free of tax throughout our lifetime, and is then left free of inheritance tax to our beneficiaries. So they've put in various bits in there to make sure that they do collect tax on the way. Things like lifetime allowance, things like the tax-free cash element that you have, that disappears after the age of 75 on death. Things like that. So there are various things that they've fiddled with, which encourages you to start using that pension fund by the time you get to 75.
Yeah. I mean, the pension fund has become a valuable place to have your money, but and that's because of the pension freedom rules since 20. And it's all about not having all your eggs in one basket. Pension is one way to help meet the inheritance tax, but there are many other solutions, and that's why it's really important that people on the webinar revisit the previous webinars.
Yeah, absolutely. Well
I think the prime purpose of the pension scheme should be to provide for retirement.
Exactly. Yeah.
With it, the government has introduced this flexibility to encourage people to save for retirement, because obviously one barrier to saving was that pensions used to die on death. They've taken that away. They're encouraging people to save, but it shouldn't be used for inheritance tax.
Yeah. Okay. Sandeep, go on.
Excellent. Okay, so Paul, question for you. If I'm a housewife not paying national insurance, what is the best option for me? Private pension, or is there a way to make NI contributions?
I will be upfront with you. I'm not 100% on the NI side, but if you can pay into a personal pension, there's nothing wrong that you make that the £2,880 contribution a year if you can, because the way you've got to look at it, that money, that's no different to being in savings. But the difference is from 55 onwards, or 57 depending on where you sit, you'll be able to access that money tax-free. 25% of it is tax-free. And given that you'll have a personal allowance in retirement still, which could be currently is at 12,500, you could draw out up to £12,500 from your pension fund without any further income tax. So you could technically draw your whole pension fund out over retirement tax-free. So it's a really good place to save for a house person.
Except you can't keep doing that.
Yes.
Yeah. I think for the housewife, if that's a question, that remember that whilst you have dependent children under the age of 18, you automatically, the housewife will automatically get a national insurance credit, for the state pension. So there's periods where she's raising a family, have children, then those years will be credited towards national insurance for the state pension. So that's there anyway. And then, but on top of that, as Paul said, everyone, even non-earners, can pay in up to £2,880, and on top of that, get the 25% tax credit to make it to 3,600. So that's a great way of saving, but that's on top of the national insurance and state pension anyway.
Brilliant.
Okay. The next one is if you have a company and you're taking out, basically you're an owner-managed company. This is to Amit, please. And you are effectively just taking out enough remuneration to cover your personal tax allowance. what is the amount that the employer can put into a pension scheme? Is there a limit to this?
Technically, there is no limit, except that if the contribution exceeds the annual allowance, then the member would be taxed on the excess as benefit in kind.
Yeah.
So certainly the employer can pay up to the annual allowance without any further taxation on the member himself. But if that particular contribution exceeds the annual allowance, then there'll be tax on the member, which is what's happening to a lot of doctors.
Okay. Yeah, that's great.
All right.
Sandeep?
So this is a question, could be for any of you, but I'm going to choose Devesh on this. Why not invest in property and derive income rather than tying up your money in a pension?
Yeah. Well, it's down to personal choice, but but why not do both if you can? You know, it's not one or the other. It's all part of your wealth creation, you know, of your lifetime, and tax efficiency. So it all goes with. And property. If you buy properties, you can have as big a property portfolio as you want. There's no restriction on how many properties you can have and what income you receive, etc. As we all know, property has been hit over the last few years with various taxes, which has made it not as efficient as it used to be. So capital gains tax on property is 8% surcharge, so it's 28% rather than 20 on other assets. The tax relief on the mortgage you had on a property, that's been eroded and is gone now if you have it personally, if you own property personally. Your rental income is going to be taxed at your highest marginal rate. You can't accumulate it. You can't say, well, I won't take my rental income this year because I'm going to pay, you know, almost half of it away in tax. You can't do any of that sort of planning. It's non-liquid, you know. So if you needed access and you're retired, you can't sell a few bricks. So it's a non-liquid asset. It's a different risk. Your returns are based on the local economy. All your money is in one currency. We know now, for example, with COVID and everything that's going on, you know, there are tenants who are finding it difficult to maybe perhaps pay rent. So, you know, your income could be under threat, etc. So it's not a right or wrong. It's not one or the other. But pensions, I mean, they have all the tax benefits, but then there's a limit. You can't put in an unlimited amount into pensions. So that's why I say it's not one or the other. In terms of what's most tax efficient, it's a pension. Can you put your pension money into a property and receive tax-free rent? Yeah. So if property is your expertise and that's where you really feel comfortable, there's nothing stopping you putting your pension fund in a commercial property.
Okay. But diversification is your key message.
Yeah.
Exactly.
My definition of a pension is slightly different from Paul's. Simply accumulation of assets or monies to provide for your retirement. It doesn't have to be in a pension structure. So you first of all think of what you were going to do naturally if there wasn't these pensions tax benefits, and then see whether you can put that in a pension scheme. It's as simple as that. There's no right or wrong answer. So, you know, governments all over the world are encouraging people to save in the pension scheme. They're giving tax benefits. UK has got the most flexible tax structure in the world, in pension structure, in terms of flexibility, tax benefits, so on. Although there are limits, but you should, you know, if you are going to do something naturally, and if that can be done in a pension scheme, then it's worth seriously thinking about.
Okay. Yeah. Thank you.
Ramit?
Yep. Right. Just, I think I'm just following up from a question we had a couple of questions ago, where we talked about the owner-owned business and the business paying the tax, paying the pension contributions into a pension scheme. And as you said, if they pay only the basic allowance and then anything over will be a benefit in kind. Now, I presume if the person's receiving, if the directors, for example, have other cash available and put money into a separate pot, a SIP, if they created one or whatever, they would still presumably get their 20% relief on day one. So they get that uplift from what Paul was saying earlier on, correct?
Yeah, the advantage of a company paying rather than the director himself personally is national insurance. Because if the director drew a salary and paid, on that, the company has to pay national insurance, the member has to pay. And then if that is put in the pension scheme, then all you get is the tax relief, not national insurance relief. So if possible, it's better to get the company to pay the contribution rather than the director personally.
Okay. Sandeep?
Okay. If I'm a disabled person and working, but my funds or savings are capped at 23,250 as per previous webinars for assessment of disabled people in needs, what happens to my pension when I retire? Devesh?
So is this question to do with somebody who's got a personal pension? They've got a money purchase pot, is it? Was that the question?
They've got a work pension. They're working, but they're disabled.
Right.
So they obviously have an assessment limit of 23,000. So yeah.
Yeah. So if they've got this cap and that money is coming from, sorry, I didn't get the full question. Is that coming from their pension fund, the 23,000?
So this is savings they've had, but say when they do retire, what then happens to pensions? Obviously, it's now going to start bringing them well over that.
Right. So okay. Well, again, if it's fixed pensions, if it's final salary pensions combined with state pensions, yes, then it could bring it over that. They can defer. They can defer a state pension. For example, if it was a state pension that brought them over, then they can defer the state pension. And if anybody defers a state pension when they're due to get it, the government will add 10.4% per year to that state pension when they receive it, and then they'll receive it as a lump sum. So, for example, if I have a state pension of, let's say, £10,000 per year, and I decide to defer it, so I don't want it now, and I defer it for, you have to defer it for a minimum of 12 months, but let's say I defer it for 3 years, 5 years, then in those 5 years, I'll get my £10,000 per year plus 10.4% interest, effectively.
That's pretty good.
And then that's paid as a lump sum.
Yeah. Great.
Really informative. Thank you.
Just I'm fairly conscious of time. We still have a little bit of time, so we're going to carry on with a couple more, 2 or 3 more questions. But for those who have, we've got a lot of questions in our chat box. So for those, in case we do not answer yours, I just wanted to let you know that we will create an addendum to the video in which we will try and answer all of the questions wherever we haven't managed to answer the questions. Okay, so let me just ask a question to Paul, please. Paul, if somebody has a pension, a private individual, if they take out a lump sum at the age of 55, right? Presumably, is there a limit in terms of what percentage they can take out? And is there a catch up in the subsequent years up to their retirement age, or what happens in that scenario?
With the pension fund,
Sorry?
With the pension fund, when you retire at 50, you can take retirement from 55. Now you can decide how much of a lump sum you want, but the maximum you can take is 25%. Yeah. So once you get the 25%, the balance, if you then start to withdraw from the balance, that will be treated as taxable income. Right. However, you could do a phased retirement where you don't take the whole 25% in one go. You take it in stages. So if you took 10% now, later on, then the remaining balance would stay in the fund and it will continue to grow. And then you can take more out later on. So it's entirely up to you how you actually do it. But the maximum is, the typical rule is 25% tax-free. The rest of it is used to purchase an income. But again, this is where you need to sit down and discuss with somebody what to do. You may decide to take the 25% to cover the next 5-10 years income, which is tax-free. So this is where you've got to sit down and talk to an individual on how you take your income and how you take your tax-free cash.
Right. Thank you. Sandeep?
What is the, for Devesh again, what is the difference between lifetime ISA and a pension? If I have an NHS pension, should I now consider getting a lifetime ISA?
Also depends on whether you're eligible. So in order to start putting money into a lifetime ISA, you have to be under the age of 40. You can then continue until the age of 50. And also depends on your personal tax rate, depends on your whether you're maximizing already your annual allowance. So if you're again, if you're in the NHS, and if you're a high earner, if you're a consultant or something, you are almost certainly likely to have exceeded your annual allowance. But the basic difference is that for a basic rate taxpayer, a lifetime ISA will give you the same tax relief as a pension. The limit is a lot lower. It's £4,000. And then you get tax relief on it at 25%, which makes it to 5,000. So the limit is a lot lower. So after that £5,000, a lifetime ISA for a basic rate taxpayer will give you the same tax relief. But there's one big difference, and that is that when you come to collect your benefit from the age of 60 onwards, the entire amount is tax-free, as opposed to only 25% in a pension. So, so for basic rate taxpayers, again, you've got to look at each person's individual circumstances and so on. But for a basic rate taxpayer, a lifetime ISA is definitely worthwhile considering, as I say, because the entire amount, you get the same tax relief, and the entire amount at the end 100% comes out as tax-free.
Excellent. Thank you.
Okay. I'm going to take this as a last question. It's for Amit. Amit, I'm now looking at somebody who is over the age of 75, who has a pension, but they have never drawn it. What happens in those circumstances? Two things. One, obviously, how can they leave the pension pot if they don't need to use it to their children or whatever? And two, if they withdrew anything from that pot, what would be the consequence of that?
Yeah, okay. Let's look at what happens on death once the member is past the age of 75. The entire fund can be left to the nominated beneficiaries, and that could be children, grandchildren, and so on.
Mm-hmm.
On death, when those people draw pensions from it, they will be taxed at their marginal tax rate, whatever it is. If the member hasn't drawn their tax-free cash sum, then they can draw that because there isn't much benefit in leaving it in the pension scheme at that point, because they can draw it, spend it, or pass it down. The rest of the monies, if they don't need it, they can keep it. They don't have to draw. They can just use it to pass it to the future generations. It depends on their needs, their own tax position. If they are sort of lower rate taxpayers, then they may do well to draw from it without penal tax. But it depends on their needs and their personal sort of tax position. But certainly the lump sum, if they haven't drawn it, that's certainly worth looking at.
Okay. Even if they are over 75, there's no issue about it.
No, they can do it at any time.
Okay, fantastic. Okay.
Can I just ask, literally connected to that question, someone has asked, how do you pass on the fund? Is it you fill in a form, or is it passed on via a will?
It's because like I said, most pension schemes are trusts already.
Okay.
All they need to do is the nomination. Now, pension benefits are paid by the discretion of the trustees, although the trustees should take account of the letter of wish. So it's very important to make nominations. Otherwise, if they haven't made nominations, those people, the trustees will not be able to consider them unless they are financially dependent or a spouse.
Excellent. Thank you so much.
Thank you. Thank you very much. Okay, if I may wrap it up, please. Thank you so much for Paul, your excellent presentation, very simple, and the panelists, Amit Shah and Devesh Ambasna. Again, you know, it's been a very, very fascinating debate and a lot of questions answered. We do have a lot more questions, so we will actually have to go back and look through that and make sure we do an addendum. There's no way we could finish off in another hour. I think we would need possibly to answer most of the questions. So I must say there's a real need for this information, and I'm really glad everybody joined us today. So thank you. Just Kilith, if you can go to the, please, we are still supporting the elderly, the vulnerable, those in isolation, and key workers. If you know of anybody needing help, this is our phone number, which is on the screen. Use that. And if you require any further information from today's webinar, please call, SMS, or WhatsApp our helpline number, which is also on the screen now. And as I said before, we are looking to put together a webinar for the government assistance for charities, which is literally going to be coming out very shortly because we're just trying to finalize a date on that. And then we've got another series of webinars, some of them relating to property, some of them relating to higher education and so on. So we are trying to get the final dates on that. Everybody will get an email to tell you what the dates are. And if you have any further suggestions for future webinars or anything else, please let us know and email us at cat8webinars@gmail.com. So without anything else, thank you very much for attending today. Be safe, stay alert, control the virus, and save lives. Goodbye.